Welcome to This Explainer. I am jumping in today as your expert tutor for the ACCA Financial Management exam. We are diving straight into Chapter 19, focusing squarely on ratio analysis. This whole area, it's basically about breaking down the ultimate business balancing act, risk versus reward. We're going to make absolutely sure you have complete mastery over assessing corporate position and gearing indicators. So often I see students drop easy marks in this specific chapter. Not because they can't do the math, you all can do the math, but because they kind of misinterpret what the numbers are actually screaming at them. Well, we are going to fix that right now.
So let's frame this whole business analysis thing as a bit of a mystery. How do you accurately measure corporate success, right? You might look at a company and see massive sales, flashy global offices, making headlines every other day. But is it truly fundamentally healthy underneath all that? Or is it just a really good paint job? We can't just guess here, and we definitely can't rely on a gut feeling. We need precise tools to cut through that corporate noise. And that's exactly what ratios are. They are literally our best detective tools to uncover the real financial narrative.
Here is our quick roadmap for today. 1. The Corporate Ratio Masterclass. 2. Measuring corporate performance. 3. Financial risk and gearing. And 4. High gearing and corporate value.
Section 1. The Corporate Ratio Masterclass.
Section 2. Measuring corporate performance.
All right, before we crunch a single number, we really have to ground ourselves in the big picture. What is the whole point of these calculations? Evaluating one main thing, maximizing shareholder wealth. That is the absolute gold standard of corporate finance. So, to see if management is actually hitting that reward, we use performance ratios. Think of these as the engine driving the company forward. First up, we've got ROCE, Return on Capital Employed. You find this by taking profit before interest and tax, or PBIT, and dividing it by capital employed. Now remember, capital employed is just all the long-term funds in the business, right? So debt from lenders plus the equity from shareholders. Basically, ROCE tells us exactly what kind of operating return management is squeezing out of every single dollar invested in the business, no matter where that dollar came from. It's your ultimate efficiency gauge and gives us the absolute big picture of goal achievement.
Next, we zoom in a little tighter with ROE, Return on Equity. The formula shifts here. It is profit after tax divided by shareholders' equity. Notice that change? While ROCE used profit before interest and tax to look at overall capital, ROE deliberately uses profit after tax. Why? Because we need to know what's left over after the lenders and the taxman take their cut. ROE strips away the debt side of things and tells us point blank how well management is compensating the equity investors. Shareholders are sitting at the very bottom of the payout pile if things go south, meaning their capital is at the highest risk. This metric specifically measures the reward for carrying that primary burden.
Now, we can break down how those overall profits actually translate into individual equity metrics by looking at these three side by side. On the left, EPS, or earnings per share. This takes profit after tax minus any preference dividends divided by the total ordinary shares. Basically, the profit generated on paper for each individual share. But move to the middle, and DPS, dividend per share, is a completely different story. This is the cold, hard cash actually paid out to each share, the tangible return. And then finally, dividend yield. We take that cash dividend per share and divide it by the current market share price. This one is absolutely crucial because it gives investors a clear percentage return based on today's market value. It lets them instantly compare this stock's yield against other options out there, like corporate bonds or treasury bills.
Section 3. Financial risk and gearing.
Okay, we've seen the rewards, but we have to ask, at what cost does this performance come? Look, every powerful engine carries some weight. In the corporate world, that weight is usually debt and fixed obligations. And sure, taking on debt can aggressively accelerate growth, but high gearing isn't just for sports cars. In finance, it is a fast track to elevating your blood pressure. When executives load up on debt, they introduce fixed interest payments. Those payments are rigid. They do not care if the economy tanks. If revenue drops, those fixed costs are still sitting right there. That inflexibility massively magnifies operating losses during a downturn. It puts immense pressure on a firm's survival. That is something management and you, during your exam, need to pay very, very close attention to.
Now, we've got two distinct types of gearing to master here, and examiners absolutely love testing if you can separate them. First, operational gearing. This focuses entirely on your income statement. The formula? Contribution divided by profit before interest and tax. It is measuring the chunk of fixed operating costs in your production cycle. So, a highly operationally geared company has massive fixed overheads. That means even a tiny, slight drop in sales volume causes a massive, devastating drop in operating profit.
On the flip side, statement of financial position gearing is all about your capital structure, how the company is funded. It's debt over equity or debt over the total of debt plus equity. Keep these two completely distinct in your mind. Operational evaluates the fixed cost structure. Statement of financial position evaluates the debt funding structure.
And when a company takes on that debt funding, well, they have to pay interest. Enter the interest coverage ratio, your vital safety net. You find this by dividing operating profit, or EBIT, by the interest payable. It quite literally tells you how many times a company's operating profits can cover its required interest payments before the whole thing hits the brakes hard. Say an exam scenario shows a company with an interest coverage ratio of 5. They're relatively secure, right? They can cover their interest 5 times over. But what if you see that ratio dropping to 1.5 over a couple of years? Alarm bells should absolutely be ringing. They are dangerously close to defaulting, and one slight dip in future profits could trigger a severe liquidity crisis.
Section 4. High gearing and corporate value.
So high gearing builds this dangerous domino effect that directly attacks the core of the business. Let's walk through the actual mechanics here. Step 1, a company takes on high debt to fund some ambitious expansion. Okay. Step 2, this immediately creates an increased interest burden, a fixed cash outflow that they are legally required to pay. Step 3, because lenders get paid before shareholders see a single penny, this causes a spiking shareholder equity risk. The potential returns for shareholders are now heavily subordinated and way more volatile. And step 4, this is where the real damage hits. Equity investors are rational, right? So they demand a financial risk premium to compensate for that spike in risk. The required rate of return, the cost of equity, shoots up. And when the cost of equity spikes, the discounted value of the company's future cash flows drops, placing a severe downward impact on overall corporate value. That high financial risk literally undermines the entire goal of maximizing shareholder wealth.
Before we wrap up today, let's run through a quick mental checklist for your exam. For syllabus areas A3 and E3, you must be able to assess the corporate goal. You need to confidently calculate those key performance ratios, ROCE, ROE, EPS, DPS, and dividend yield. You absolutely must be able to differentiate operational from statement of financial position gearing with the correct formulas, calculate that interest coverage safety net, and explain that step-by-step value impact of high debt. Master these, and you are going to absolutely crush this section of your paper. I'll leave you with a slightly provocative thought about your own risk appetite. Knowing the hidden risks of gearing, how differently are you going to view a highly geared, high-performing company tomorrow? A roaring engine is incredible, but only if the brakes work. Because in finance, true mastery is knowing exactly when the reward justifies the risk. Thank you so much for joining me for this explainer. Keep practicing those calculations, and I know you'll do brilliantly.